Welcome to your natural gas futures market analysis as we head into the weekend. Today, we'll break down the technical setup, key levels to watch, and the fundamental factors that could drive price action in the coming sessions. The market has experienced a dramatic shift from earlier this year's highs of $4.90, currently settling near $3.11. This significant downward movement has brought us to a critical technical juncture, specifically below a symmetrical triangle breakdown. This bearish continuation pattern suggests mounting pressure on bulls as we approach next week's trading. From a technical perspective, two major bearish signals demand our attention. The confirmed triangle breakdown project's targets near 2.69, while a black swan harmonic pattern indicates potential confluence around 2.3. The crucial support level to monitor is $3.07. A breach here could accelerate selling pressure toward these lower targets. For bulls to regain control, they'll need to reclaim $3.05 and subsequently break through $3.49 to reestablish upward momentum and potentially open a path to $4.08. However, there's a potential bullish scenario worth considering. The market could form a triple bottom near historical support levels of $2.99 and $2.85. This formation would establish a solid foundation, but it's contingent on bulls maintaining the $3.07 level through the Sunday session. A strong bounce with substantial volume could catch bears off guard and trigger a significant reversal. Weather developments over the weekend could serve as a key catalyst. Bulls are anticipating a potential hotter weather flip, specifically looking for weather models to revise temperatures higher by 5 to 10 degrees, particularly in the Northeast, Southeast, and Ohio Valley regions. However, it's important to note that weekend model runs historically display a cold bias, making cooler revisions more likely unless we see an unexpected shift. The fundamental landscape presents additional headwinds for bulls. LNG terminals are operating at full capacity with no major export disruptions on the horizon, eliminating the possibility of a bullish supply shock. Powerburn demand has shown weakness, declining nearly 4% week over week despite heat, largely due to robust wind and solar generation. Storage levels remaining above the 5-year average further reinforce the bearish fundamental outlook. For traders positioning for next week, the game plan centers around the $3.07 level. A break below this mark would confirm bearish control, opening the path to $2.69 and potentially $2.43. Conversely, if bulls successfully defend this level and receive support from weather developments, we could see a squeeze toward $3.25 with possible extension to $3.49 and $4.08. Stay vigilant in monitoring weather model updates and LNG flows, and maintain close attention to price action around the critical 3.07 zone. We'll reconvene Sunday night to assess how these factors have evolved and adjust our strategy accordingly.